get that first big job, and I wanted to close that first big deal. And it was always this external pursuit, right? And those things all achieved. It all happened. It was great. But there was something missing. Like, what's missing, right? And part of that was reestablishing my faith.
Welcome to the Picture of Wealth, or TPOW as we call it. I am your host, Dustin Service. That is the voice of Brett Swarts, and Brett is in California, and he is a specialist in commercial real estate, and more importantly, the exit of commercial real estate. He's got a great strategy, a great business called Capital Gains Tax Solutions, and his whole strategy is around people who have got a commercial building that has grown in value, and they are going to pay a lot of tax to get out of it. So how do you essentially not pay the tax or minimize your tax? And he breaks down this strategy on how to do this. So for any of you who like commercial real estate, who want to learn about the ins and outs of rental real estate and how to cash flow and how to look at properties, how to analyze properties quickly, and how to try and find good deals, this is the podcast for you. So without further ado, I bring you Brett Swarts, diehard 49ers fan, basketball scholarship in university, 2 degrees, very sharp guy, and he's a great podcast guest. Brett Swarts, I'm excited to have you on the show today. We're going to be talking about financial strategy, but more specifically, strategy around commercial real estate, which, listener, I know that's you. I know this is something that intrigues you. Brett is in the U.S. and advising clients on certain tax strategies and also helping people as a licensed commercial real estate agent find, multifamily commercial. You're going to unpack that. So, Brett, thanks a lot for being on the show today.
Dustin, pleasure to be here. Thanks for having me.
So let's warm up with, commercial real estate in the U.S. What was the affinity for you in the past? Why do you think it's the best investment?
Yeah, I grew up in the real estate industry with my parents, so I couldn't help but fall in love with the sticks and bricks of real estate and what it meant to be an entrepreneur and have cash flow and development. And so this is the Silicon Valley, Bay Area, East Bay of California. And we just learned and loved real estate from a young age, and it just became a part of us. Fast forward, by us, I mean my brother and I, and we would drive Bobcats and hammer nails and shoot, nail guns, and all kinds of just cool stuff as a kid. Almost killing ourselves, multiple times, but we survived it. And fast forward, we had a chance to study and practice multifamily investment brokerage at a place called Marcus and Millichap, which is one of the top commercial brokerages in the U.S. As it pertains to investment real estate. And that's when we learned about 1031 exchanges and ways to build wealth and underwrite and IRRs and cash on cash, and essentially how to get some financial freedom. If you could own enough real estate, it could pay for your living expenses, right? And you don't have to trade time for dollars. But that wasn't always the best thing, because we saw friends and family and clients lose half or everything in the 2008 crash. And so, although it started out exciting in 2006 when I started there, things quickly changed when 2008 hit. And I saw friends, family, and clients lose half or everything over the next 3 years. And that's when we learned that it's not just enough to have a cash flow plan. You've got to have an exit plan. And that exit plan has got to suit the freedoms that you're looking for. And it could be time freedom. It could be location freedom. It could be also financial and retirement freedom, but it could also be entrepreneurial freedom. It could be diversification freedom. A lot of different things that go into when you go to exit something and what it could mean for you and your family. And so I just became a sponge. I started to learn from a CPA and a tax attorney who's a genius. And I just started to just absorb what was possible. And then I started to apply that to my business, because my business had gone from a little bit to like crash. I'm living at home with my baby and my wife, and we're in my brother's small condo, barely surviving, working side hustles at a place called Cheesecake Factory. And I always share that part of the story because it was a grind and a hustle for a couple of years. But as we learned new strategies and we helped our clients get out of their challenges, they were losing millions. I was barely surviving. But we quickly started to, help more people, and our business started to grow. And now all I do is teach and train and coach people how to do this being advanced tax strategies on the excess of crypto, business, investment real estate, or primary homes. And it's really fun. It's exciting to be able to help and serve, clients across the country.
Oh man, listener, where do you want me to go with that? He just opened up the door to so many different avenues, but I'm going to stick with, maybe we'll come back to crypto later, because it's often a big head scratcher for a lot of people. But commercial real estate. So what are we talking about? Is this, Grant Cardone, if you're a commercial real estate person, is like, minimum buy a 32 unit thing. Are you prescribing to the same thing, or are we talking, right down to duplex? Like, is that what you're helping people buy or advising?
Oh, good question. So our in the beginning, yes, it was a lot of smaller properties, but also, we just helped a client sell a $7.7 million property in Sacramento. And they decided to do a 1031 exchange. We helped another client. He just sold five mobile home parks in Moscow, Idaho, which is a little bit closer to you guys. And this was Gary Lester. He shared his whole story, $10 million. And he was looking for time freedom. He had financial freedom, but he didn't have time and energy freedom. And so he shared his whole story. This was a land deal for a client of mine named Tom.
So he's holding up a brochure. Is that the brochure for the mobile homes, or what?
This one was, This is actually Gary right here. If you're watching this on video, see if it's going to focus here. This is Gary, and he shares his whole story. You can share on my YouTube channel. But yeah, Gary is a guy who wanted some financial freedom, right? And he's just like, you know what? I want to get mobile home park investing, right? He was kind of an entrepreneur, but also kind of working the W-2. He was hustling, and he goes to a seminar conference, and he goes, okay, I'm buying one this year for sure, right? Takes action, massive action, and then he buys 2, 3, 4, 5. And all of a sudden, the values shoot up to $10 million. And he's like, man, I got all this cash flow, but I don't have my time and energy freedom. And he goes, life is short. He goes, COVID has taught us a couple things. Number one, life is short. Number two, go out and live what you want to do. Don't wait for it, right? Like we were talking before the thing. And this is Gary's story. So, but he doesn't want to do a 1031 and trade 5 mobile home parks for 10 mobile home parks. He's like, doesn't make any sense. I have 5 problems right now. I don't need 10 problems, right? And he goes, guess what? The deferred sales trust is what we specialize in. I can exit. I can defer my tax. I can also keep getting tax cash flow, but I can be passive. I can be active, right? So the key, what we really do is we just help people unlock the freedom with their capital. And sometimes that means buying a duplex or house hacking that. We have a real estate team across the country. Sometimes that means syndicating deals and putting money into one of our multifamily properties and projects. Sometimes it means exiting that business. We just had a $10 million, it was a $17 million exit. The client had $7 million into the trust. And so the business sold for a big amount. His portion was $7 million. And for him, it's like he wants to move to Tennessee out of California and be a little more retired, but he's still pretty young. He probably wants to do some entrepreneurial stuff. So everyone's a little bit different, but our key is just to try to figure out how to help them get from where they want to be, which is a B, and A is where they're at. And that involves multifamily investing. That involves tax deferral and exits. That involves, also we work with financial advisors. Sometimes it's, securities and investments in that sense.
So beep, beep, beep. That's the truck backing up. And I have to ask, for a Canadian, what's a 1031? And for a listener in the US, I'm sorry if you already know what this is, but I think it's important for you to unpack this strategy that you're actually talking about.
Yeah. So 1031 exchange, by the way, anyone can use this no matter where they're from. If you have assets in the US, you can use a 1031 exchange. So if you're a Canadian, if you buy something in, Washington for $1 million and you sell it for $5 million, you're going to have a $4 million gain, and the government's going to tax that typically 25 to 50%. The U.S. government, at least. Canadian could be a whole other part of that side of the story there. I think it could be double sometimes. It's a huge tax. And so what you do is instead of paying that tax, you can defer it as long as you buy a property, let's say of $5 million or greater at that point. So it's basically trading your one equity of $1 million that went to $5 million, and you're moving into another piece of property, 1031 exchanging it into a bigger property and deferring that tax and keeping the money working for you.
Okay. So let's use Mr. Mobile Home Park. He had 5 mobile homes. Is in that article, does it talk about numbers or no?
Yeah, it's a $10 million asset. I mean, all of them collectively are about $10 million. They're 5 mobile home parks, so big parks, and collectively selling to one buyer for $10 million. I think his basis was right around, we estimated to be right around like $2 million. So he had about an $8 million gain, right? And so you have the state of Idaho, you have the federal tax, you have the Obamacare. We estimated about at least 30% of that $8 million would have been wiped out by capital gains tax. And so he's like, I'm not in the business of just getting crushed by tax. I'm in the business of building wealth. But I'm also not in the business of overpaying for property, especially with cap rates that are going lower and interest rates that are going higher. Or not, cap rates aren't necessarily going lower. Maybe they're flat, but definitely interest rates are going higher. And so he's like, this is crazy. He also has some debt on the property too. So he's like, I'm in debt. I don't have my time and my energy. I have some financial freedom, But he goes, this isn't serving where I really want to be, right? I want to be out. And so the deferred sales trust is the debt-free plan. He got out of his debt, right? He diversified his equity and he got his time back, which was his biggest thing that he was trying to achieve.
And he leveled up. So what did he take say he got 10 million, he had $1 million in debt, so he got 9. So then you have some sort of structure that 9 goes into, and then he bought an apartment building that's a lot simpler, or what?
Good question. Yeah. So far the money's just sitting in the bank, and it's in I think like U.S. Treasury bills right now, and maybe in a little bit of stock. Like we just this one just closed 2 weeks ago, and this is the coolest part about the deferred sales trust is you don't have any time restrictions. Like you don't have to rush around and make investments. So we eliminate that whole shotgun wedding, right? We all have the friends that got married really young or really quick, and you're like, well, we'll hope that works out for you, right? But 1031 exchange can feel like that, where you're selling something and rushing around to buy something. In this scenario, we can sell and we can be quiet and calm and just wait and look for opportunities and dollar cost average. We can put some of it into the stock market, some of it into U.S. Treasury bills, some of it into multifamily projects, some of it into a business venture, some of it into crypto, some of it into lending funds, right? Essentially, you can diversify and be passive, or you can partner with the trust and be active. And this is where you have entrepreneurial freedom or retirement freedom. And so that's the key. Like, what freedom are you looking for right now? If you are listening to this and you have a highly appreciated asset, what is it that you're trying to do? Where are you trying to go? Why are you trying to go there? And the question is, once you clarify that, well, what's the tool to help you get you there? And what's the team to help you get to there, right? Because we don't need more money. We need more people, right? The people have all the money, or the people have all of the ideas to unlock the freedoms we're trying to seek. Okay. And these are the things that are really important. If you can build that dream team to help you with whatever it is that you're trying to achieve, then it's really the sky's the limit. This is why you want to listen to these types of podcasts, so you can be obviously encouraged and challenged and pushed forward to go find that team to help you execute.
Yeah, that is great knowledge there. So I want to flip to the other side of whatever you want to call it, the volleyball court, the tennis court, and think of somebody now. So right now we're building a portfolio, and you mentioned the cap rates. Again, when I look at, I'm an owner of real estate, commercial real estate. I follow it, even though I'm passionate about the market as well. I am a real estate supporter, and I can't make the numbers work for a lot of them. And so either the ones that hit the market they shouldn't have hit the market. You try and find them sooner, so they don't hit the market. But I'm always thinking in the market, there's a buyer and there's a seller. So there's someone selling thinking, I got to get out. And then there's buyers thinking, I got to get in. So in your case, when you've got like a 3% cap rate, and listener, if you want a quick tutorial, it's like what you collect in rent in simple terms versus what you pay creates a number, a percentage. We'll call it cap rate. That's a really simple analogy, but it's a quick way to go, okay, how much rent do I collect? How much I got to pay? That's a number, and you can compare another property by doing that. Right now in our region, say Western Canada, you've got cap rates of 3%. You've got foreign buyer. In residential real estate, we've got the Airbnb craze going on in our region, where people seem to think that those numbers make sense. But how do we vet properties quick enough and find a good deal?
Yeah, good question. And I think I'll make it even simpler for those who are wondering what a cap rate is. Your cap rate is your unleveraged rate of return. So for example, if I buy something for $1 million and it has a 3% cap rate, right? My cash on cash is 3%. My cap rate is 3%. It's the same thing. It's the unleveraged rate of return. So that's $30,000, right? $30,000. So the question is, what are other investments paying right now? That's the first thing we always look at. Like, are you going to buy this $1 million? You're going to put $1 million down, right, to go buy this asset that's only paying you $30,000 a year? How long would it take you to get this your $1 million back? Now, part of real estate is to leverage. So maybe you're putting $1 million down and you're buying a $3 million asset, right? But now you have debt. Now that debt is around maybe 6.5%. Not also ideal, right? So now you're in what's called a negative leverage event, where 2 of your 3 million is costing you 6.5, and your 1 million is only on the 30,000, right? or still on the full 3 million, depending on what you bought it for, right? That's the cap rate. So that scenario would be 90,000, right? But it is not looking great, right? Whereas a year ago, we could buy something, let's say at 3% interest rate, and maybe a 4 or 5 cap. And by the way, hopefully you're not buying 3 caps. It's just crazy in itself. But the only way people make sense of these kind of things, Dustin, is what's called a value add appreciation play. A value add appreciation play. So there's really kind of 2 things I'm really looking at. I'm always looking at cash on cash return. Like if I put money in today, what am I getting tomorrow? Like immediate. Number 2, how quickly can I grow my NOI, my net operating income, right? To instead of a 3 cap to a 4 or 5 or 6. Is there a way that I can do that through what's called forced appreciation, which is basically when you come in and you renovate a unit, you add the washer dryer, you do the landscaping, you clean up the place, the old tenants are out. Those are hard to find. And then you raise the rent, let's say it's $1,000 a month to $1,500 a month. And you do that across 100 units, right? I don't mind if I'm buying it at a 3 or a 4 cap, right? Depending on what I can borrow at. Because if there's no rent control and I can get the tenants out quickly, then I could carry it for a year, maybe a year and a half. And every time I can knock out a tenant and I can get an extra $500 per tenant across 100 units, now all of a sudden my cash on cash goes from 3 or 4 to maybe 5, 6, 7, or 8 or 9. And if I leveraged it correctly, my appreciation skyrockets and then I can sell. So that's the name of the game. So it's not a simple answer. Of course, there's demographics. Of course, there's if it's a pro-growth, pro-business place. Of course, what are the rent comps? What are the schools in the area? Would you want to live there? These are all these, general things you see. What are the utility costs? What are the insurance costs? Is it in a fireplace or a flood place? Like there's so many nuances there, but that would be my suggestion to you, Dustin, if that answers the question.
No, it for sure did. I'm happy that you sort of broke that down further. So is there, you're in California. Is there deals in California?
Taxifornia is tough to make sense of, right? Because it's so expensive. So let me tell you, there's deals everywhere in every market at all times. The question is, are you looking at enough deals, underwriting enough deals, making offers on enough deals, touring enough deals to actually know what a deal is, right? So we get to study and practice the art of buying, negotiating, refinancing, exiting properties. And that's what a good broker does, because they're studying and practicing it on behalf of all their clients so they can help you do that. So now it becomes, what is a good deal? Well, it's like anything. If you go shopping for a car, you go shopping for a whatever. If you can see 100 cars in 10 different dealerships, you could probably go, okay, well, based upon this pattern, I see a deal, right? There's a deal. So what are you studying and practicing, right? And then do you have the capital available? Do you have the expertise to take it down? Do you have the broker relationships, or are you direct to owner? I mean, these are all the things that you got to have a team. It's tough. If you want to, you got to get started somewhere. So sometimes that means buying the duplex. Sometimes it means buying the 10 unit. But if you can get 100 units, that's really powerful, right? And if you can do that with the team, that's even better. And then you can scale that. I recommend just going big right away if you can, to building that team, doing it with some partners, 75 or 100 units minimum. Ideally 200 or 300 units at a time. But everyone's in a different spot.
So give us the latest example in your portfolio or in your recent advice, a multi-unit. What are you paying for something like a 75 unit building? Like or give us your recent example of one that's a multi.
Yeah, so there's one right now. We're working with. I'm a small GP and I brought in some investors and stuff. And it's like 200 units. It's Texas, and it's what I call a semi value add, in that it's most of it's already a lot of the value's already been added. A lot of the owner put a lot of money into the deal. And the rents that we're looking to achieve, though, still have a gap between right around $200. As the units turn and maybe some light renovations, we can raise it by about $200. So within 3 to 5 years, we hope if you put $100,000 in there, we're hoping to get your 100 back plus maybe $60,000 or $70,000 in addition to that, which is pretty good, right? Right. And And in the meantime, you get cash flow of about 6% or so. But you also get what's called depreciation to offset the income. And collectively, a lot of different investors, a lot of LPs, just a couple GPs. And then it's rinse, wash, repeat. We say, okay, we put 100 in, we can get, 200 would be great if we get 200 back at the end of 3 to 5 years. But in the meantime, we collected about 6%. We got depreciation on this side to offset our cash flow, right? We call this tax flow. That's a powerful way to do it. Does that make sense?
Yeah. So I'm going to back up again and get you to unpack two things: GPs and LPs. What that actually means. And
yeah.
Okay, go for it. You can,
general partner and limited partner, right? So general partner basically is the active owner or active partner that's doing the work, buying the deal, negotiating the deal, hiring the property management, is the property management, managing the operations, managing the debt stack, managing the investor relations. Like, it's everything that has to do with actually doing the work. The LP or limited partner are like silent partners. They typically just put up capital and then they just go keep doing their day job, right? But they get a percentage of the ownership. Typically, it could be like a 70-30. The LPs put up majority of the money. They get 70% of the ownership. The GPs, let's say, get 30% of the ownership, but they do, it's called sweat equity. They're doing the work to earn that. They typically get an asset management fee of a 1% or so, right? And then they get their payday typically at the end. They'll still get some cash flow as part of the ownership, right? But at the end, if they achieve, let's say they bought it for 10 million, it goes to 15 million. They may have put no dollars in and put all the sweat equity in. Well, that extra 5 million would be split 70-30 after the preferred return is paid back to the investors. Preferred returns are like 6 and 8% typically to the LPs. But it's a win-win because the LP's like, well, I don't have the time or the energy to do it or the expertise. I have the money that I want to do it. And the GP says, I have the time and the energy, and they may or may not have the money, or they have a lot of deals going, but they're like, look, let's scale this business across, 10 or 20, 30 properties. Let's do all the work. Let's earn the sweat equity on the exits. And that's where we come in as well. And we say, okay, when you exit, we just did a $48 million deal in Las Vegas for two GPs. This is their 5th deal they did with us. See if I can pull up the picture for us here. And in this scenario, they have millions of dollars. This is a $33 million deal in Vegas right there. And you can watch David tell his story on this. And this one, he was GP on.
Or is it residential?
Yeah, it's a multifamily. Yeah, multifamily project there.
Low rise multifamily. Okay.
Yeah. And so Las Vegas. And so, but 33 million, they crushed it. And so he and his other GP partner and also an LP partner all ended up going into the deferred sales trust, defer their tax. And that's when they can move that into their next deal, all tax deferred, right? So this is the cool way that we're doing all the exit planning and the strategic investments.
On the LPGP, so here's a personal story. For a couple of years ago, I was approached, a pitch man, whatever you want to call it, a guy who had an idea, and it was a retirement home about 4 hours from where we are. So there is no retirement home there. Get all the specs and the demographic. It was about a $30 million build, and so multifamily. It's not a nursing home, but a
assisted living or yes, memory care. Yeah. Uh-huh.
Yes. So
yeah,
great idea. And that demographic around there would kind of fit that. Would they pay the rates he was talking? I don't know. But, his minimum investment was 500 as sort of these tranches of investment. So that's fine. When I asked him about how much he was putting in of his own money, so a client of mine always, he'll laugh because he's a listener, skin in the game. And I said, how much skin in the game do you have? Well, he said, I don't have lots of money. Or now I got, 200,000 that I'm going to put in of my own money. And it was like I thanked him for the meeting. It was exciting. And he left, and I kind of scratched my head after, and maybe I'm jaded. Maybe hopefully you can correct my beliefs that his risk is pretty low for taking on, I'm considering bringing clients in and introducing them to this idea. And if it doesn't work out, he's out 200K. So how do you handle that? Or how does the GP have such little? I get the sweat equity, but he's got to still do it when I've written the check as the LP and it's gone.
Yeah, it's a great question. And I think it's good insight. And so, especially on a $30 million ground up development, assisted living, memory care, or anything that has to do with senior housing, That's even more complex. So the first thing you're always going to ask in a sponsor is track record, right? Track record. So, okay, so 200,000 is your all you're in for. Yes. I'm curious, how many of these have you done before? How many $30 million builds from the ground up? Excellent. Can I see these? How much money did you put into those ones? How are they performing now? May I speak with 10 of the investors that were in that deal? If he hesitates or says no or doesn't have it, then you shouldn't even have the meeting in the first place, right? So now I also invest in senior housing memory care facilities, right, as an LP. And what's cool about the way he does it, the GP, he puts 50% of his own money in.
Love it.
The other thing is he is signing on all the debt. So sometimes the GP can be the key principal, and they're putting their debt in their name. And so this particular key principal, by the way, the group that I work with, 50 years in the business, his parents did it. They have over 30 projects in 8 states. They have an amazing track record of performance. Right. I mean, it's just in their first class in their communications, their culture, their leadership. I remember because actually representing them on the buy side, they all flew down in a jet, and they jump in these minivans for the renter cars, and they have 8 guys, and I'm the broker representing them to buy the land. I hadn't met the guys. They're actually from Washington, and they're flying down to California, and they land in Sacramento, and they get out, and I meet them at the property, and we're going through it. And it's like these worker bees. They all like land in these little cars, and they all go out. And the guys on laptops, I'm just watching all this happen. And then I hop in the van with them, and they're like, just like going. And I'm like, I was around like the machine of it all, right? Like, and this guy's worth, I don't know. This guy could be worth like $1 billion, the one guy, right? Yeah. And he's the guy, he's driving the car, he's driving the van. It's a minivan, right? And so it was just so cool. And I'm like, wow. And I got to see their project, and guess what I wanted to? They didn't even ask me, but I said, hey, can I invest with you guys, right? Can I roll my fee in there? Can I bring my dad in the deal? So they weren't like selling me at all. In fact, they didn't need me at all. And they just allowed me. I actually came in for a smaller amount. Their minimum is typically 200. We got in for 50K. And so that's the point. So what's the track record, right? What's their performance? And then you're right. How much is in the money? Now, for example, if this guy who does put 50% of his own money in and sign on the debt, and he's been doing it for 50 years with his family and all this stuff and has all this success, if he came to me and said, Brett, this particular deal I'm only putting 200 in, but I've built, 20 projects in the past 36 months, between 15 and $30 million, and they've all been successful, I probably wouldn't be as concerned about that, right?
Yeah.
Right. But if he doesn't have that, then you're right. I would stop right away and be like, this is too much risk for anybody. Or even if he said, I put 50% up, go to the flip side. Yeah, I'm going to put up $15 million of my own money. Wow, that's pretty amazing. How'd you get that 15 million? Where did it come from? Right? How did you earn that? And why are you willing to risk that on this? And by the way, how many projects have you done? And if he hasn't done the projects, I don't care if he puts up 15 million or 200,000. Does that make sense?
Yeah. No, that's great. So can you help, listener get their head around how you find a deal? And is it realistic that a common person, never done a deal, could put a partnership together to do something? Or should they seek a closed fund, or should they seek to learn? Or, where I'm going with that question?
Yeah, I think it's all of the above. You got to study and practice being a GP and an LP. The top GPs I know are all LPs as well. And they're going to other people's funds. They're going to other people's deals. They're seeing their communications. They're seeing their underwriting. They're seeing their deals, their opportunities. Like it's investing in your education. When I became a broker at Marcus & Millichap, our goal was to get on the other side of the phone, which meant become the owner of the real estate that we were trying to help people sell. And really, it was an investment into our education. We got to sit and listen to people that are millionaires, 10 millionaires, a billionaire, right? When you get to sit and talk and learn that, our minds and our opportunity is limitless, right? Really, right? To the extent that God gives us certain things, we all have different gifts, right? But that's the key. So if we can connect and be with, around, and learning from all of these others, the better. And then, take action, right? What does that mean? It could mean start raising capital. Could mean start building broker relationships. Could mean buying your own deal. What is it, the gift that you've been given, right? And how does it best serve and help other people? What value are you going to bring to the GP relationship? Are you going to be the guy who finds the deals, negotiates the deals, ties the deal up? even the guy who raised the capital, who raises the debt, even the operations. You want to be behind the scenes and just manage the assets, right? Like, what part do you want to be in? And then find other GPs that are as passionate about you and values driven as you are, align with them. And because we can't all do all of it really well. In fact, that's the hardest thing, right? If you want to go far, right, go with others. If you want to go fast, you can go alone. But that's the other thing too. How are you going to raise all the capital? You're going to take all the debt on yourself. There's a lot there. So I really would recommend aligning with people that align with your values, and then who have this a complementary skill set to you.
Where do limited partners and general partners hang out? Is there websites that they, we could do Tinder basically, like swipe right for an apartment building?
Yeah, good question. Yeah, so the people that approach us that want to invest with us, when we create a lot of content online, like you do, like a podcast, and we speak at events and get to know people, and we just show them our deals. Like, I mean, we did a $13 million deal in San Diego, and then we did a $29 million deal in Texas, and then there's a $2.2 million deal in Walnut Creek, and here's one in Georgia for 7.7. So what I found is just a lot of people, you can talk and talk and talk. I think you guys have a saying up there in Canada, right? Don't just give me the steak. I don't need any of the sizzle, right? Just literally just show the stuff that you're doing, right? Or introduce them to people that are already doing the thing. And like, this is what I've done. This is what I've done. This is another one I just closed. We closed 5 deals in this month in December. We're in January now. And so that's really it. Create content, serve people, add value. People are naturally going to be attracted to that. Write blogs, go to Bigger Pockets, go to Facebook groups, go to real estate meetups, read the books, buy the books, get into masterminds, go to the conferences. I mean, we already know all this stuff. It's just a lot of work and it takes a lot of time. But if you're passionate enough, you can do it.
Brett, I did, and people can look up your bio and look up your success online and figure out that you're doing well and kicking ass. But what do you do in your own world? I'm not asking for specific numbers, but how do you balance? And listener, Brett's got 5 children. So how do you balance your own world of, like, you make good money? Okay, what do you got? Okay, I see your family. What does it say?
Oh, go, keep going. You keep talking. I was just showing for people who want to see the family.
Okay, yeah. So we got a great family. How do you manage where you spend your own money? Do you make decisions with your spouse? Do you allocate all your own money into real estate? Because that's obviously your, what we call wealth edge. You're good at that. Your risk is lower that you're focused on that. But is there a strategy, or is it pretty much at your age, just go hard business, reinvest in the business, and take as little out as possible? I've given you a good question there.
It's a good question. It's a couple different parts, right? So first thing is I try to practice the habit of working harder on myself than I do on my job. And it's a quote from a guy named Jim Rohn, and the quote continues to say, if you work hard on your job, you'll make a living, and there's nothing wrong with that. That's fine. But if you work harder on yourself, you'll make a fortune. And the idea is not just to make a bunch of money, although that's really cool because you can help a lot of people and have a lot of fun, right? The idea is to become everything we were created to be. So that's our health, our finances, our fitness, our family, our personal development and leadership, our faith, right? These things are all so important, right? And if you can focus on working harder on that, like a lot of us, like especially with me, I know my story was, hey, I wanted to, get that degree. And so I wanted to get that basketball scholarship, and I wanted to, get that first big job, and I wanted to close that first big deal. And it was always this external pursuit, right? And those things all achieved. It all happened. It was great. But there was something missing. Like, what's missing, right? And part of that was reestablishing my faith. And that changed, no matter what was going on the outside externally, I was centered in my faith. And for me, it's Jesus. I'm a Christian, right? Like, it didn't matter if everything else was going wild and crazy. I'm at peace. I can't explain it. Okay. It's a spiritual thing. The other thing could be opposite, right? Everything could be going amazing out there externally on the world kind of stuff. But internally, if I wasn't focused or, connected with Jesus in an intimate way, like, something's missing. I can't explain it. My dad wasn't a believer. He's still not. We're praying for him. He's still not. My mom is. And so I had both sides growing up with the public schools, heard all the stuff, And so for me, it starts right there, the foundation of my faith. Now that moves out into our family, right? With my wife and I married 13 years. It's our money, right? It's her money. In fact, I have to tell her, hey, this is your decision too. Like, you can't just, tell me to make all the financial decisions. Like, this is our decision collectively. Okay. So we want to practice, in the beginning it was Dave Ramsey, like paying off all the debt, right? Getting a clear budget, right? It's like getting in shape. We paid off $64,000 coming out of college of credit card debt, a little bit of student loans. And like, it was kind of a mess, but for 26 months we buckled down. We lived in a $135,000 house and just paid it all off. And it was great. And then fast forward, as we built the wealth, we just try to study and practice, certain ratios. We give about 10% away, to causes we believe in. We try to invest and save a good percentage, and we also enjoy our wealth as well. And so all of these things. Now we also try to get 7 different income streams, right? Is our goal. Okay. The average millionaire has 7 different income streams. And so as you get multiple income streams, especially if they're passive, guess what? It takes a lot of pressure off of that, just that one income stream. And so these are all connected in steps. And I think that answers the question, but I don't know, Dustin, what are you thinking?
No, it's a great, because everyone does it different. And as an entrepreneur, and especially if you're successful, it can feel lonely sometimes. And you might not feel open enough to share with, other people, or, unless you're part of mastermind groups or confidential places. So it's always nice to kind of, and I'm grateful and thank you for sharing that with us, of kind of a deeper dive. But I had a lot of fun. Is there one thing that you're most excited about in the real estate space or crypto, or, this would be your chance to enlighten us on what are you, based on all of your experience and knowledge, most excited about in, the commercial or wealth space, as you see the interesting economy and world that we live in now?
Yeah. So we're in the largest wealth transfer in the history of the planet's happening right now, Dustin. Okay. In the history of the world, there's never been more wealth transferred ever. And in fact, there's about 32 trillion is the estimate that's passing from the baby boomers. These are our parents, right? To us in the next 20 years, 32 trillion. Think about that, right? And 50% of all of that wealth is tied to high-end primary homes, businesses, and commercial real estate. And they're illiquid assets that are subject to huge estate tax and capital gains tax. And so it's our opportunity, and actually our responsibility, to educate people on how to exit and move funds outside of the taxable estate and or defer capital gains tax, so that the wealth stays with the people versus going to a government that will waste it away in about 10 seconds. Okay. And so the freedom of, really, and this, I'm speaking for America right now, the freedom of America is directly tied to who controls this 32 trillion. And to mean that we can give it to the causes we believe in. Now, the good news is, if we use advanced tax strategies that we have, capital gains tax and estate tax strategies, when they exit, the funds actually create more tax revenue, because the funds need to go into businesses or investments and create housing and all these really cool things. So everybody wins. Government wins too. But people who don't know about them and don't execute them, don't have a team, gone forever. Okay. So there's 10,000 baby boomers turning 65 every single day. And there's over 77 million in the US alone. Now, this also applies to Canadians as well. If you have properties, actually, it's even more so to you guys, okay? Because if you have properties, let's say in Washington or California or anywhere in the U.S., okay, you are subject to, you only have a $68,000 as approximately estate tax exemption. So let's imagine you're worth $50 million, okay, Dustin, and you own, and all of it's in a New York apartment complex, and you live in Canada. If you do not exit and move it into something like a deferred sales trust plus, you are subject to 40% of that 50 million being wiped out by the US government. And nobody wants that, right? And so instead, you as a Canadian citizen, or if you're in Europe or wherever you're at, you sell, you can move it outside, you can eliminate that 40% death tax. And this is such a powerful thing that we're on a mission to train and coach 10,000 business professionals across the US so that they know how to do this and are aware of it. And otherwise, they're going to get wiped out, and it's going to be brutal. Okay. So that's the biggest thing. It's not about cash flow anymore. I mean, it is, but if you're a multimillionaire, you probably already figured the cash flow thing out. It's about tax flow. tax flow. Because guess what? Government spending is out of control. Inflation is out of control. 31 trillion alone in the US for debt. So you've got to focus your attention from your cash flow to your tax flow.
Tax flow. And you've if we only had another hour to debate sort of the world, the economy, but that could be another podcast, and the transfer of wealth. And I love how you put it, that it is a win-win for the government. And so, listener, again, can't stress enough the power of a team. I can't stress enough the power of, ETFs were a big thing back, 4 or 5 years ago. Low fees, do it yourself. Advisors are shit. Well, guess what? The wealthiest people in the world usually don't do it themselves. So, Brett, give us a summary of where people can find you online.
Yeah, I think go to capitalgainstaxsolutions.com. You can also search that on YouTube or iTunes or Spotify. It's Capital Gains Tax Solutions. Our YouTube channel, by the way, is filled with an amazing amount of playlists that break down the 1031 exchange versus the deferred sales trust, and kind of helping people unlock what's possible with exit planning. You can also look out the new book that's coming out. It's called Building a Tax Deferred Exit Strategy. Kevin Harrington from Shark Tank's in the book, and this is the proven playbook for unlocking your ideal wealth plan on selling assets of any kind for yourself or for your clients. And it's called Building a Tax Deferred Exit. It's going to be on Amazon here shortly, so look for that as well.
Awesome, Brett. Thanks a lot.
Thanks.
Thank you for tuning into this episode. If you enjoyed the show, please like and rate the show, share with a friend, or use your new knowledge in your next conversation. If during the show something gave you a pang of inspiration, motivation, or sense of uncertainty, act on it now. Get the clarity you're looking for. Find the permission you seek. Go to servicewealth.com to discover how others are learning how to take Fridays off, or buying a recreation property, or spending more money. If you're an organizer of an event where you believe my philosophy on finance and lifestyle design would be applicable, go to servicewealth.com and book me as a speaker at your next event. If you want a copy of our new book coming out soon, send me a message on Instagram or Facebook, and we will be sure to get you a first copy.